Groupon, the billion-dollar mirage. In November 2011, Groupon went public on the Nasdaq as the biggest internet IPO since Google. The company had reached $1 billion in valuation faster than any business in history. 7 months later, it restated its 2011 revenues downward. Today, Groupon still exists, but it's a skeleton of what it promised to be. This is the story of how a company solved a real problem so well that it destroyed itself in the process. The story starts with frustration. In 2006, a 24-year-old named Andrew Mason was trying to cancel his mobile phone contract. He couldn't. The company wouldn't let him. Mason thought, what if we flipped this? What if instead of one person negotiating against a corporation, hundreds of people negotiated together? In 2007, he built The Point, a platform meant to organize people around shared goals, any goals. It flopped in Chicago. Then something unexpected happened. A group of Point users organized around something simple. They wanted a discount on pizza. They rounded up enough people to negotiate a bulk deal. Mason and his investor, Eric Lefkofsky, saw it. They pivoted entirely. In November 2008, Groupon launched. The name combined group and coupon. The first deal was 2 pizzas for the price of one at Motel Bar on the ground floor of their Chicago office building. The growth was not gradual. It was exponential. 18 months after launch, Groupon employed over 350 people and was valued at $1.35 billion, April 2010. By October 2010, the company operated in 150 North American cities with 35 million registered users. The model worked: find a local business, offer their service or product at a steep discount if enough people commit to buying. The merchant gets customers. Groupon takes a cut. Everyone wins. In June 2011, Groupon filed to go public. The IPO prospectus claimed the company was on pace to make $1 billion in sales faster than any other business ever. Morgan Stanley, Goldman Sachs, and Credit Suisse underwrote it. On November 4, 2011, Groupon rang the opening bell on the Nasdaq. The IPO was the largest internet offering since Google's in 2004. Then the problems started immediately. Regulators and analysts noticed something in Groupon's financial filing, a metric called Adjusted Consolidated Segment Operating Income, ACSOI. This was not a standard accounting measure. It was custom-built. When you stripped away the standard accounting rules and used Groupon's metric instead, the company looked profitable. When you used actual accounting standards, it looked like it was losing money. In August 2011, facing scrutiny, Groupon updated its filing to acknowledge the controversy. But the IPO had already priced. 7 months after going public, in March 2012, Groupon restated its 2011 revenues downward. Investors had been shown one number. The real number was smaller. In the company's first earnings call as a public company, it reported a $9.8 million loss in the fourth quarter of 2011 alone. Here is what changed nothing and everything. Groupon's fundamental business model was mathematically broken from the start, but no one saw it because growth was too fast. The economics looked simple. A restaurant normally sells a $50 meal for $50. Through Groupon, they sell it for $25 because of the discount. Groupon takes half of that $25, so $12.50. The restaurant makes $12.50. Groupon makes $12.50. Sounds balanced. Except it wasn't. Groupon's actual cost of acquiring each customer was higher than the profit from that customer's single purchase. The company was paying for massive marketing, engineering, office space in 150 cities, and hundreds of salespeople to sign up local merchants. Each new user came at a cost. That cost was front-loaded. The revenue was back-loaded and small. The math only worked if each customer bought dozens of deals, stayed loyal for years, and Groupon could eventually amortize the acquisition cost across thousands of transactions per person. It never happened. Groupon grew by chasing new cities, not by deepening penetration in existing ones. It was a treadmill. Each new market required the same expensive infrastructure. Growth masked insolvency. The faster Groupon expanded, the more it lost money on each expansion, but investors saw the user numbers and the top-line revenue, not the unit economics underneath. Andrew Mason and Groupon's leadership knew the path to profitability was narrow. They needed to reduce customer acquisition costs or increase customer lifetime value. They chose a third option instead. They changed how they reported profitability. By using ACSOI instead of standard metrics, they made losses look like gains. This wasn't fraud in the criminal sense, the numbers were real, just reorganized. But it was deception in the functional sense. It told investors a story that contradicted the underlying reality. When the IPO priced, Wall Street believed it. When the numbers were restated, the market understood. The company had been hiding what the actual business looked like. The stock fell 70% in its first year. The real lesson isn't about accounting tricks or even about flawed business models. It's about what happens when a company grows so fast that nobody, including the founders, has time to ask whether the growth is profitable. Speed becomes a substitute for strategy. Expanding to 150 cities in 2 years feels like victory. It feels like proof of concept. But it can also be proof of bankruptcy in motion. Groupon solved the hard problem, connecting customers to local merchants at scale across 13 countries. But it never solved the harder problem, making money doing it. And by the time investors asked, the company had already answered in its own language, a language designed to make the answer sound better than it was. By 2024, Groupon still operates. It shifted to digital vouchers and shed the physical goods business. It's profitable now, technically. But it's a company that once seemed destined to reshape retail, now running a coupon website. Not because the idea was bad. Because the growth was an illusion, and illusions eventually break when they collide with math.